Okie dokie, Banoki. Welcome to another episode of Compounder's Corner. My name is Amos, and in this video, we'll be going over the companies that are reporting their earnings this week, and we'll just be talking about the stock market in general. And let me tell you right now, if you can't tell by looking at your screen right now, dude, it is the biggest week of 2026 so far in terms of earnings, because half of these companies, they're on my watch list. And for the past 6-7 weeks, dude, I've been buying into the fear, the sell off, the correction, whatever you want to call it. And I posted on the communities tab my performance so far for the past 12 months. I think it's like 42, 43% into the green. So when you want to talk to me about how dividend growth investing does not work, just look at the facts. Okay. Now, before we hop into the podcast, I can finally share the big life update with you all. Do you remember how we talked about it a couple weeks ago? Dude, I'm so freaking stoked. I don't even know how to share it. But just like how investing has different seasons, right? Bull markets, bear markets, fear markets, whatever, life does as well. So in a matter of weeks, gosh, I can't believe I'm saying it. We're going to be moving back to the United States from Japan. Dude, I am so stoked. If you're a friend of the channel, if you're a regular, then you know I'm so fed up with living here, right? I think Japan is a solid place to visit or go on vacation for like a week, maybe 2 weeks. I'll tell you right now, living here day in and day out, the culture, the mannerisms, just everything about it gets on your nerves, especially if you weren't raised in East Asia. Like, you won't understand what I'm saying. But anyways, the reason why we're going back to the US, my wife, she's starting a new professional chapter that involves several months of specialized training. I feel like that's the best way I can say it. And I'll be joining her for that entire period so that our little family can stay together, right? We have a newborn. Because of that, as soon as I'm done filming this video, we're going to be taking an inventory of everything that we have, and we're going to be packing everything down to what fits in a few suitcases, giving stuff away, donating, and all that good jazz. And the rest of our stuff that we want to bring back with us, it's going to go into a shipping container, which means, gosh, my normal recording setup is basically gone for a while. Whatever can fit inside of a backpack, that's what we're bringing. Because we have 2 dogs as well, so we have to bring all of their stuff, their toys, the baby gates, and all that jazz. So, yeah. So over the next several months, the channel's going to be in a transition season. Okay, I'm going to be living out of a suitcase for the rest of 2026. So uploads, gosh, it sucks because they're already less frequent. Because prior to baby girl being born, I used to upload once to twice a day every day. So sometimes I would upload like 60 videos in a month. Now we're lucky to see 4 to 5 videos in a month, right? But I already know during this move and everything else, it's going to be so chaotic, so stressful that I know I'm not going to be able to upload as much. But I promise you the mission will stay the same, right? The goal of this channel, the objective is to educate people about dividend growth investing, but also finding high quality compounders and how to build wealth the smart way. Not get rich quick schemes, not day trading, none of that stupid stuff, but keeping it simple, keeping it easy, right? Buying high quality companies when they're on the dip. So I'll keep it like that still, but if anything, I think this is going to be a great test of keeping things simple and focused. I'll also still be active on Patreon because I feel like for me, it's so much easier to just write something up and post it than it is to write a script, to film, to edit, to create the thumbnail. There's a lot of work that goes on behind the scenes. But for Patreon, I'll continue doing the work that I do on there. And one more thing, please don't fast forward, okay? I've been saying how the used car prices in the US, just ridiculous, right? So we're gonna need a family car. We actually don't have one because I sold both of our cars back in 2022 prior to coming to Japan. So we're looking at a minivan or an SUV. So if you're living in the Florida, Alabama, Louisiana, Gulf Coast region, and you've got something that's reliable, and you're thinking about selling it, and you want to let it go, you want to just get rid of it, feel free to reach out. I'll pay, okay? No pressure at all. But I thought I would ask the community first before I go inside of a dealership to get ripped off. I'm a pretty good negotiator, but yeah, just the whole going back and forth with their finance manager, with the sales guy on the floor and all of that, not a fun thing to go through. But anyways, let's go ahead and talk about this week's earnings. But before we do, in case you missed it, some videos that were recently uploaded onto the channel. Number one, we uploaded a stock analysis on Trex, which is a composite decking and railing company that's been soaring in valuation as of recently. Like, no joke, in the past 5 days, they're up 15, 16, 17% into the green since I uploaded the video, which I think is kind of hilarious. And then I also uploaded a video about why investing in the face of fear is a good thing. No matter what's happening, to be investing. And I think most of us can use that friendly reminder that time in the market beats timing the market. Because I know, based on a community post poll, that 1/5 of you guys sold everything and you were sitting in cash. So, yeah, to sell everything at a loss and then to watch everything rally back up to new all-time highs and then to jump back in, I just feel like that's not the wisest utilization of capital, right? To buy high and to sell low. You kind of want to do it the opposite way, right? Buy low, sell high. That's basically the investing philosophy of SCHD. They buy dividend compounders with cheese when they're near their 1-year low, and then they sell out of them 12 months later. That's basically what I try to do on an individual stocks basis. But anyways, on a high level, let's talk about the biggest takeaways from this week's earnings. These are the 5 key themes that I could think of. First and foremost, we have the Mag 7's Tesla reporting on Wednesday after the markets close. We also have other big tech players such as Intel, Nokia, ServiceNow, IBM, Lam Research, and Texas Instruments. And based on AI demand and spending from previous weeks, especially ASML from last week as well, I think forward guidance for most of these companies should be bullish, except for maybe ServiceNow. We'll see. Number 3, we also have airline flyers like American, Alaska, Southwest, and United. We also have some of the biggest names in the military-industrial complex, like RTX, GE Aerospace, Boeing, Lockheed Martin. And one thing you have to realize about the defense stocks is that they don't live or die on the earnings. I don't think the stock market really cares too much about their EPS and all of that. Rather, they live or die on the backlog, like how much money of future obligations are they going to be on the hook for, and progress of their deliverables, such as planes, missiles, and drones. Let's say they're supposed to deliver 7 F-35s by the end of the year. Are they on pace? Are they on target? Are they going to hit all their KPIs to getting 7 or even 8 jets delivered? That's what the market cares about. And then, of course, we have the health insurance giants, such as UnitedHealth, Elevance, and Molina. And now we're going to jump into each day of the week and look at the names in a more closer format. I think Monday is a really good way to just ease into the rest of the week because there's nothing crazy here. I would say Alaska Airlines is probably the most famous one, maybe Bank of Hawaii. Other than that, I don't think there's anybody here that's too noteworthy. But as we jump into Tuesday, this is where it gets a little interesting. So April 21st, we have GE Aerospace, and then number 2 is UnitedHealth. Okay, so they're one of my core holdings. Let's just click and take a look at what's going on with them. Year to date, negative 1.6%. But if we only look at the past 1 month, 13% into the green, past 5 days, 6% into the green. As it looks like they're slow and steady, they're going back into the green. In my hypothesis, when I uploaded video about the health insurance landscape, I think like a week or two ago. I said UnitedHealth, I think they're going to be going on a very slow, there might be some speed bumps along the way, but on a path to $350 by the end of the year. I can absolutely see that happening. When it comes to UnitedHealth, I think the biggest metric that you want to take into account is their medical loss ratio. So in the health insurance space, it's known as the MLR, and it's the percentage of the premiums that are spent on care. So every month or on an annualized basis, people pay into their health care, which is known as the premium here in the US. And of that, how much does UnitedHealth use for people when they're using it for treatment, services, surgery, and everything else? And we want to see that number as close to 80% as possible, which means about 20% is left over. If it moves to a number that's closer to 90%, I'm saying it right now, this stock will sell off to $265 by the end of the week. Okay? I'm not kidding. And something else that's going to be really important, another metric, is their Medicare Advantage commentary, because that's one of the biggest reasons as to why they were selling off alongside with all the other health insurance stocks, because the government, for the longest time, they were trolling them, because inflation means the cost of living goes up for everything, right? The cost of goods, the cost of services, that includes medical treatment. And the government was like, hey, well, you know what? We'll bridge the gap and we'll help reimburse it by 0.09% or something like that. But the lobbyists and the health insurance companies petitioning, it worked, because that number is going to be a lot higher now. I can't remember off the top of my head. I think it's like 2.xx%. And because of that, that's why they're rallying back up into the green. So this is a company that I bought into right here at the end of July into August. My cost basis is like 250 something, maybe 260 something, and I've been holding on to them. Even when they rebounded up to 264, I didn't do anything. When they sold off, I didn't do anything. They rebounded to 350. They sold off, I didn't do anything. I'm just holding on because I know eventually this is a $600 a share stock. And to just jump ship right now, I just feel like it's too premature, and I know I'm going to regret it. So I will be paying attention to UnitedHealth. Even if they go on a sell-off, oh well, I'll hold on for a longer period. And if they rally, good news for me, right? I'll be happy. And then there's also RTX. This is the company that sells a lot of the missiles and drones being used right now. Intuitive Surgical. And then there's Danaher. Let's talk about this one. It's an industrial science conglomerate that basically has their hands in every corner of biotech and healthcare. And that's essentially why their stock price is beat up. If we jump on over and I show you what we're working with, year to date, negative 15% into the red, 6 months, actually I'll do 1 year. Prior to them selling off, they did reach a high of about $242 a share, and now they're roughly $194 a share. And you might be like, well, hold on, their forward trading multiple is too expensive at a 23. But historically, this is a company where their trading multiple is around 40 or 50, easily. But the reason why they're selling off is the current party in power. They've been slashing funds across the board for anything related to research, science, biotech, because they're saying it's wasteful spending, right? And as such, money to Danaher has been drying up because there's less labs in business. This is a company I talked about, I think 2-3 weeks ago. Now the time has come for me to put my money where my mouth is. I do want to buy into them. They've been on my watch list since 2019. I interviewed for this company. I got a job offer from them. I turned it down because the compensation package wasn't that great. It was like $160 all in. This was back when I used to be a corporate monkey. And I didn't really hear too much about the location that thrilled me and the wife. So I didn't really want to move to that office. So I was like, I'll just stay put. But that's something I encourage most of you to do every single year, multiple times, maybe once a quarter, is to interview. That way you can find out where you sit on the chopping block in terms of, is your compensation fair? Like in case something goes wrong in your office, you have a backup plan, you can jump ship to another company. But also it's really helpful, every 2 to 3 years to pivot and go to another company. That way you can increase your pay by 10, 15, 20%, but also gives you a change of scenery, a change of pace, change of everything, right? A fresh slate. I think it's healthy to do that, right? Gone are the days where you just stay loyal at one company. You put your head down and you grind for 20 years only to get laid off so that they can replace you with AI, right? So it would behoove of you to always be testing out the waters, test out the markets, see what your market value is, because you might be comfortable as a senior manager, but if you're willing to pivot down the street to your competitor, you could be a director and get an automatic 25% boost in your compensation, right? You're pretty much going to be doing the exact same amount of work, same amount of hours. That's something I did. Every 8 to 12 weeks, I would interview with different companies just for fun, right? I would go all the way to the end, get the offer, play with it, and be like, nah, I'm all right. But anyways, Danaher, I really like this company, and it is one that I do want to buy into. Obviously, I think they have some more room to fall. If you're invested into Danaher, I really do apologize, but for selfish sakes, I really do hope they sell off just a little bit more so that I can jump in. Because this is a dividend compounder with cheese, dividend growth rate being 20%. I don't think you understand. That's a crazy, ridiculous growth rate. If you take a look at their top line, it is just bananas, right? 2005 was 7.8 billion, and now it's 24.5 billion. Their EPS growth, let's see, it's been pretty much stagnant, or actually shrinking since 2022, $8.47 down to $5.05. Take a look at their free cash flow situation, free cash flow per share. Okay, so that's pretty good, $7.35. So Danaher is company number one that I do want to buy into for next week's earnings. And then let's go back and see what else we've got on Tuesday. We've got Chubb. This is a very high quality insurance conglomerate. And take a look at their performance, okay? 6 months. 23% into the green, past 5 years, 100% into the green. And out of the insurance landscape, I broke down every single major player. I think they have like a B grade from me. They're high quality, super solid. But I'll tell you right now, this is a company where I just feel like when earnings arrives, they're going to crush and they're going to rally. So there's no point in me even talking about them because the opportunity to buy them for me, not going to happen. There's also Capital One Financial. I know this is unpopular, but I personally would rather buy into Capital One than Visa and MasterCard. So when it comes to like the payment processing toll booth monsters, for me, number one is American Express because they cater towards a higher discretionary spending customer base. And when times are good or bad, that top 1% of Americans, their spending habits is going to stay just fine, right? So for me, American Express, I'm bullish about. Number two, I like Capital One Financial because they're also the parent company of Discover. I really like Discover. I used to be invested into them, and then Capital One freaking acquired them. And then I was like, okay, well, whatever. And so I don't own Discover, and I think I sold that to Capital One or whatever happened. It was like a couple years ago. And then after that, I would say Visa because Visa pretty much has a monopoly with the debit cards. And then number four would be MasterCard. I'm not really in love with MasterCard, although I do think it's high quality. I think for me, MasterCard is an A tier. Just so you understand that, I think all of them are high quality. Visa is S tier. Capital One is S tier. And then obviously American Express is S tier for me. But having the opportunity to buy into any one of those four, for me, American Express all day long. And no, I'm not invested into any of them. There's Northrop Grumman, another military stock. I think, yeah, they're selling off after the highs with the conflict in the Middle East. They reached $774 a share, and now they're $665, and I think they're going to be free falling because I think the conflict is coming down to an end. I mean, obviously, there's still some skirmishes, some targets being blown up and whatnot, but for the most part, I think the large-scale, catastrophic World War III event, I think it's behind us. There's 3M. I really like 3M. It's an industrial company that pretty much has a patent for almost anything you can think of, including window tint, Scotch, Velcro, just whatever you could sell at a stationery store, at a mechanic shop, at a shipyard. They have so many freaking patents across the board. I think it's a pretty funny company. They did have some lawsuits like 3-4 years ago that made their stock tumble. And I bought so much 3M at the time. And everything worked out because 3M eventually rebounded because it's a blue chip company that was just going through some temporary headwinds. Yeah, right there. I bought the dip in 2023 when they were roughly, I don't think I caught the bottom of $86, $85. I think my dollar cost average ended up being like $95, $100 a share. And then once they rebounded to like $135, I jumped ship. But that was almost too easy. Just because they were going through a temporary storm of all these lawsuits and legal cases, people thought this was a company that was going to go defunct. Could not be further from the truth. When you talk about a company whose history is as long as 3M, for me, I was like, all right, I'll just jump in. Pretty high quality. I like 3M, but regardless of what happens Tuesday, I'm not really interested in jumping back in. There's MSCI. They're a pretty good company. I would say it's a parallel play to S&P Global, NASDAQ, because they also own what would you say, like the proprietary data and royalty fees for a whole bunch of ETFs, annuities, options, futures. It's lesser known, but the reason why I don't want to pick them over NASDAQ or S&P Global is that they're way too cyclical. You know what I'm saying? Like every single 6 months, they go on a high, and then every other 6 months, they go on a massive sell-off, a high, a sell-off, a high, a sell-off. It's just, yeah, it's too volatile for my taste, but it's definitely high quality. I really do like them. Dividend growth rate being 12.8%. This is a good one. I mean, I wouldn't mind jumping into them when they reach one of their valleys, just to jump ship near one of their peaks. But nah, I'd rather not. There's United Airways, which, yeah, not really interested in them. There is a credit reporting bureau, Equifax. There's Tractor Supply Company. This is one that's been on my watch list for almost 5 years, I would say. 2021, when I did a deep dive into them, because during the pandemic, a lot of people picked up hobby farming, where you basically raise your own fruits and vegetables in your backyard, or even have some chickens, so you can have some fresh eggs every morning. And this is a company that caters towards the middle-class suburban customers that just want to buy gear in order to do just that. But they also sell oversized farming equipment for people in the middle of nowhere. So they have a really interesting business model. Whereas Lowe's and Home Depot, they cater specifically to the DIY home remodeling, home rebuilding folks, or to the professional contractors. Tractor Supply Co., they're catering towards the farmers and then also to the rich folks that want to be farmers as a hobby. Really like them, and between you and me, I do have buy limit orders in right now because I'm eyeballing them for their earnings, and I'm hoping I can jump in. This is a company I do want to add, and if I do, next time I upload a video for the public portfolio series, I'm so sorry. I've been meaning to upload an update. My hands have been so freaking full, taking care of the baby, taking care of the house, cooking, cleaning, laundry, groceries. Every single day, at the end of the day, like I look at myself in the mirror, dude, I have bags under my eyes, and I aged probably like 5 years in the past 6 months. Baby girl just turned 6 months old a couple of days ago, and I aged 5 years in 6 months. The lack of sleep and the amount of stress just keeping a little human alive, it's pretty crazy. It's also a pretty rewarding experience because the other day I kept thinking like, dude, this sucks, right? Like, I know I'm smart enough to be a value add to a major corporation in a director role, but here I am, a stay-at-home dad, raising a baby girl, and I just feel like I was wasting my potential, right? And then my wife orders something on the internet, and when we got the package, I opened it up. so that I can clean it. So we start using it. And in the packaging, it said, hey, being a parent and raising a child is one of the most important jobs you can do. So if no one has said it to you recently, I just want to say it to you. You're doing a great job, parent. When I read that, dude, I almost teared up. I was like, holy moly. Because, like, no joke, I was thinking about throwing in the towel, saying, screw all of this. I'm going to jump back into corporate America. We'll pay for a nanny. We'll pay for daycare. I don't want to do this anymore. But then I realized, like, dude, I feel like in 10 to 20 years, when baby girl is all grown up and she's an adult and she has all these freaking memories with dad raising her, dad playing soccer with her, dad teaching her about dividend investing, dad teaching her about politics, history, arithmetic, science. I feel like that type of memory, that type of bond, that type of relationship, I feel as if it's going to be the right move over picking money. Because I'll be honest with you, the only reason why is because of the money. I'm like, dude, I want to jump back into corporate America just for the money. Even though knowing full well when I'm in these corporate meetings and telling my team what to do and delegating tasks and then having their end of the year meetings about how was your performance, there's nothing more that I want than to go home and hang out with baby girl, right? So it's like, I have to remind myself to suck it up, because this is exactly what's right and what I should be doing as a father right now. Which is weird, because the household dynamics, the wife is the breadwinner, and I'm the 1950s wife, right? Cooking, cleaning, diapers, and all that. It's interesting, right? And then my portfolio, it's compounding in the background, so that's always good, all right? But anyways, there's also, what do we got? I think that's a mortgage REIT. I haven't looked into this company since 2019, and I don't think I want to look into them. There's Agree Realty. I think if we're going to be talking about commercial real estate, number one for me is Realty Income Corporation, the monthly dividend payer, ticker symbol O. I think number two would be ADC, Agree Realty. I think they're so good. And then a distant third, I think like a B tier, would be NNN. The triple net lease. It's a play on words, but basically NNN REIT. Really good as well. But all else being equal, why would I go with triple N when ADC and Realty Income are in the S tier, right? Like, that's how my brain works. Like, why go for something that competes in the exact same space, but they're not best in class? When I pick a stock, when I pick a business, when I pick an investment, I try to buy the best house on the block. What blows my mind is when investors try to be cute, when they try to think outside of the box and they try to go for something that's a D tier or C tier, knowing full well the best in class is also going on a sell-off. So why not buy the best in class, right? Don't buy the shed that's on the corner of the street. No, buy the biggest freaking house with the best market value that's also being, when the entire neighborhood gets sold off and everyone gets punished without discrimination, don't bother with the C, D, F, dare I even say B minus tier. Just focus on the A or the S tier ones, because they're best positioned to survive, they're best positioned to thrive, and they have a durable, robust business model, which is why they're S. But anyways, whatever. I know there's a lot of people who are shaking your heads and disagreeing with me on that one, but it served me well, because whenever I'm on the fence about an investment, I go through my own investing philosophy slide deck that's available on the Patreon. And it always like reminds me of like, okay, does it have this? Does it have that? Like, does it hit all of the check boxes? If not, as hard as it is, if I take away emotions and feelings and FOMO and I look at it objectively on paper, it helps me to stay grounded to say, no, I'm okay with not jumping in. 9 out of 10 times, it has served me well. I think the only time it hasn't served me well is Oracle Corporation. Dude, I've been eyeballing them for the longest time. I made a deep dive video prior to baby girl being born. And I kept saying, like, yes, I know their balance sheet is horrific. Yes, I know they're highly leveraged. Yes, I know they're making a 100% gamble to OpenAI, basically throwing down billions of dollars of Capex to build out data centers to support OpenAI. And I kept saying, like, dude, I'm going to jump in. And I just couldn't do it, right? Because of the leveraged and debt situation. Because when I think about the companies that are also in the same caliber and tier, such as like Microsoft or Amazon, right? They're also building out massive infrastructure and data centers, or even Google and Meta. They can be included into that conversation. They don't have a horrific balance sheet like Oracle, right? So ultimately, I ended up going with Microsoft. I ended up going with Amazon. I ended up going with Google. And I did not go with Oracle. But now Oracle is soaring to the sky. And I'm like, darn it, I kind of wish I jumped in. But I think that is something you can't really turn a blind eye towards. I think there's a lot of like subjective metrics that can be good or bad or just kind of whatever. But one thing you cannot ignore is if they're drowning in debt. If a company is drowning in debt, all it takes is for one small pushback, setback, speed bump, or litigation risk for that company to go tumbling down. Because if you're drowning in debt, dude, you are screwed beyond belief, right? It's hard to go bankrupt if you don't have any debt, right? Like off the top of my head, Cal-Maine Foods. They're basically have a monopoly, like what, 22% of the market share of the eggs sold in the US. They don't have any debt on their books. So it's impossible for them to go belly up. But at the same time, it's a commodity, right? The price of eggs goes up and down, and their EPS, their most recent earnings, I tuned in, it went down by like 40, 50, 60%, something like that. Actually, I want to pull it up because it is a company that I said in the deep dive analysis video, they're nice, but it is way too cyclical where I do not want to buy into them. And people were like, why not? Their dividend's so juicy, because this is why. Just take a look at their EPS. Up and down, up and down, up and down, up and down, because it really depends on the price of eggs. And so for their most recent earnings, sorry, this is on an annualized basis. So on their most recent earnings, you saw that their gross sales, how much money they're bringing in across the board, their revenue, went down by 53%. Why is that, Amos? Because during the pandemic, there was also the bird flu that caused, the avionic flu causes a huge amount of shortages, right? So the price per chicken, per egg goes up because it's supply and demand. People have to pay more when there's less supply, when the demand stays high, okay? So because of that, they were charging like what? You guys tell me, I live in Japan. I think it was like what, $9, $8 for a carton of eggs? Even here in Japan, the price went up. Not like you guys. Like prior to inflation in Japan, the price of eggs was 98 yen per 10 eggs. So it's like 60 cents US. And as of right now, it's like 190 yen. So it's like $1.15 US. I think for you guys, when the bird flu shortage for the eggs occurred, I think it was like $7 or $8 per carton. And I heard as of recently from an economist's podcast I was listening to, the price of eggs is back down to like $2.99. So how much money they're going to be making is only going to be decreasing here on out, because the price of eggs is coming back down as the supply of healthy chickens are back to normal. So their margins are also oh my goodness gracious, their profits per share decrease 90%. Do you see what I'm saying? So do you honestly think their dividends are going to be sustainable? Like, I will tell you right now, the dividend math, the payout ratio, it's computed from the EPS, correct? So if the EPS is shrinking 90%, this dividend is 100% going to get cut, because the annual dividend payout is $8.36. Their last quarter, they generated $1.06. Do you really think $8.30? No, it's not. It's going to get cut. And so my conclusion was, I'm not going to invest into a company that I know for 100% they're going to cut their dividend. Like, why would I invest into it knowing full well it's going to be a dividend cutter, right? And the whole idea of dividend growth investing is to buy into high quality compounders where they're not tied to a commodity cycle, where it's cyclical, where their dividend growth rate is set in stone. It's going to be increasing 10, 20% year over year. I would never, ever buy into a stock where their dividend is going to be cut in a matter of 6 to 12 months. It doesn't make sense. Okay. And there's a Korean bank right there, Hanmi. Other than that, I think there's a lot of regional banks that I really do like that are reporting on Tuesday, but I'm not going to be paying attention. And then as we jump on over to Wednesday, let me just get a water break. It's starting to heat up here in Japan. It's getting a little toasty. Oh my gosh, there's nothing better than a cold glass of water, especially if you're thirsty, right? If you wake up in the middle of the night, or if you're on a ruck march, or you're running a marathon, whatever it is, dude, if you're thirsty and you get some of that nice clean water, My goodness gracious. So on Wednesday, we've got Tesla. So here's what I think is happening. I don't think Tesla is low quality, but their stock price has been selling off. And I think that's because it's an anticipation for the SpaceX IPO. So I think a lot of people pulled their money into Tesla because that's the only publicly traded vehicle if you believe in Elon Musk and his future and all of his endeavors, right? But now that you can actually invest directly into SpaceX, I think the people that are Elon Musk bulls, they're pulling their money out in anticipation for the IPO. That way they can just pump it into SpaceX because Tesla's future is not in EVs. I think we already understand that BYD and Zhumi, I think one of you tried to put me on how to pronounce it correctly. I probably butchered it, but we already know that Chinese EVs in the next 5 years, they're going to just be best in class. I think Tesla's going to be out of the picture. So he's making a pretty hard pivot right now to Optimus, the robots, and I think they're even allocating their manufacturing facilities in California to create those personal robots instead of cars, because I think he knows he lost the battle. But robots? Yeah, I think that's a new venture he could be best in class in, but we'll see. Anyways, I think people are going to be putting their money into SpaceX, and while we're on that topic, I don't know about you, but it kind of grinds my gears when all of these big tech companies are putting all of their eggs in one basket in order to advance AI to replace human butts and seats, but also physical robots to replace humans. Because when you think about it, it does not make economic or social sense for robots and AI to literally take over all the jobs so that you and your executive team can high five one another. Because think about it. And an economy still needs people with discretionary spending to buy what machines produce. If humans lose all of their jobs, how the heck are they supposed to spend money? Right? So that's why I'm like, y'all are being short-sighted. I feel like robots and AI, it's helpful as a tool, as a like a secondary resource, but to make every human obsolete, what kind of dystopian future is that when we're all going to be just useless because a robot can do it better than us, because an AI can do it better than us, right? So it's like, I don't know. I hope there's some protections being drafted up so that it can be put into place, because if all the humans lose their jobs, there's going to be no such thing as any other stock succeeding. Who the heck is going to be able to buy Coca-Cola, McDonald's? Who the heck is going to be able to buy a car, a house, pay for your internet bills when you don't even make money, right? So I hope they think twice before screwing over the 90% of the citizens who aren't going to benefit from AI and robots. And that's why, I can see the future, and that's why I'm investing into these stocks. Because if they're going to win, I might as well benefit from it as well. Right? And I feel like dividend income is one way to kind of create my own universal income. But that's for a topic for another day. There's Lam Research. I told you guys, when it comes to the semiconductor manufacturing equipment companies, my number one is Lam Research. Why do I say that, Amos? Because a year and a half ago, I created a deep dive video on Lam Research. And once I got to know the company on a deeper level, I was like, holy moly, I'm super bullish about them. Their top line expectation for this earnings is 22% growth. Their EPS, the expectation is a 31% growth. This is a company that has so much expectations baked in because they are front and center of the AI chip movement. They don't care who's the winner. It doesn't matter if it's NVIDIA. It doesn't matter if it's AMD. It doesn't matter if it's Broadcom. You're going to still need the picks and shovels in order to make those darn chips, right? So my number one is Lam Research. My number two is Applied Materials. My number three is ASML. And that's not to say ASML is trash. Lam Research to me is A. Applied Materials is A-. ASML is B-. Still very high quality. For me, even if a company is C tier, that's still enough for me to invest into them. That means they're doing everything they should be. They're average. They're middle of the road. Okay? Ideally, I only like to invest into A or S tier, but a C is enough for me to invest into, just to give you kind of like an understanding that a B- to me is very good. Now, a D and an F, that's where I draw the line. I absolutely will never go near the company, no matter how cheap they are. It doesn't make sense. Because when I buy into a stock, worst case scenario, right? I'm going to have to hold on to it for 10, 20, 30 years. And if I buy into an F tier business operation and I'm going to be having to hold on to them for decades, dude, it's going to be a terrible feeling. But if I buy into an S tier, an A tier company, and they go on a sell off in the short term, it doesn't really matter because in the grand scheme of 5, 10, 20 years down the road, they're going to recover and they're going to be at all new time highs and it's not going to matter, right? Because they're S tier, A tier, they're always going to find a way to be relevant. They're going to find a way to crush. They're going to find a way to innovate. So yeah, there's Philip Morris International. Honestly, I'm not really a fan of the tobacco stocks in terms of like what their products do to people, but I have you know that I am an investor of Altria, ticker symbol MO. Very juicy dividend payer. I do not support their business operation, but I kind of look at it from, I guess, a numbers perspective. Their dividend profile is just phenomenal. But I do have a little bit of a cognitive dissonance. It's like, dude, it's a crappy business operation. But then where do you draw the line with the morality of investing, right? Because every single company in one way or another, they're evil. Google, Palantir, Nvidia, AI, everything you can think of is evil. Coca-Cola, McDonald's causes diabetes, obesity. So everybody is evil to a certain degree. So I think about it like that. It's like we invest in order to make money, and what their products do to people, like, yeah, it might suck, but it's ultimately up to the individual to make the right choices, to not do this or that. Maybe that's why I also invest into UnitedHealth, right? That way they can get their services and treatment. So maybe it's like a double-edged sword. But that is something that I sometimes I have trouble with myself, right? If you're a friend of the channel, then you know I invest big into military stocks. And I do hear the argument. You know, I'm a military veteran. I was an infantry officer. And even when I served, you know, I did have some of those like female friends that had armpit hair, vegans, that said some very derogatory stuff to me. Like, you're such an evil guy. I always thought you were a good guy, but how could you go over there and be doing such inhumane acts? You know, I thought about that and I was like, you know, even when you serve in the military, to one group of people, you can be considered evil, right? And to another, they say thank you for your service. So it's like, it's really polarizing. And that's why when it comes to investing, do you know what I'm saying? Right? Once you start playing that morality game, it's hard to invest into anything, right? And if you're invested into a 401k or into VU, SPY, VTI, believe it or not, you're invested into Altria, casino, gambling stocks, alcohol. Like, you're invested into all that as well because it's a part of the index. So I don't know. I need more time to think about it because it's one of those things where, like, when I go on a run or when I'm showering, I'll think about it here and there. But I do have trouble with it, right? Because ultimately, I'm not really a fan of what it does to people, but yeah, I'm rambling. And on one of the slides for my investing philosophy slide deck on the Patreon, it talks about do not ever get your feelings or emotions involved when it comes to investing, either for the downside or the upside. FOMO, panic selling, or greed, because you'll make stupid decisions when you do that. Instead, think of this all objectively. Look at the data, look at the numbers, look at the financials, look at the fundamentals, and think about it like that. Because if you think about businesses with an emotional lens, you'll miss a lot of money. I'm saying that right now. Because if your moral compass, your value system, dude, it's a slippery slope, right? You look at the numbers. If it prints cash, it has an economic moat. It has excellent free cash flow, superb balance sheet where they are flush in cash and not much loans. That's a high quality business operation, right? And I absolutely think you can separate investing from personal values. You don't have to love a business to invest into it, right? I don't love Altria, but I still invest in it. So I don't know. Maybe as I grow older, maybe as I get more mature, I'll change my stance. But I don't know. I'll think about it some more. Maybe one of you guys can write your thoughts in the comments. Help me out on this. Because I'm sure you've had the same dilemma, right? You're investing into X or you're investing into Y, knowing full well the argument against it. Oh, it's so bad for society, or it does this, or it causes this, but you still invest into it. Like, help me out here. I think my brain is fried right now. But anyways, Wednesday, we also, let's see, what else do we have? There's AT&T, there's Boeing, oh, there's CME. We just covered them, did a dedicated deep dive video on them. CME, it's basically an exchange where you can bet on the future price of anything, including oil, gold, copper, silver. It's where professional gamblers go instead of like poly markets or sports betting. No. This is where the commodities trading business, it prints cash. Super high quality machine. I would love to buy into them, but I think they're a little too expensive, friends and family. Actually, in the recent weeks, they've been selling off. I'll tell you this right now. If they do sell off after their earnings on Wednesday, I think I might be able to jump in. CME is exactly the type of business that I like. High quality, predictable, reliable, boring. I mean, just look at their revenue situation year over year. It just goes up and up and up. I really like this one. So CME, let me write that down in my own personal notes so I can keep an eye on them. And then, trying to go back to this. We also have ServiceNow, a very popular SaaS operation. They were featured in my SaaS tier landscape video that I uploaded like 4 weeks ago. ServiceNow to me is a tier 2. If you have no idea what I'm talking about, go watch my SaaS landscape video. They're essentially an enterprise backbone software business that connects every department's data to one another, from finance to sales to the operations to everybody involved in an organization. Really important. And there's a few companies that do what they do, including Oracle and SAP. SAP pretty much has a monopoly in Europe. And ultimately, I boiled it down, like Oracle, I really wanted to jump in, right? Because of their partnership with TikTok, and I'm super bullish on TikTok. I felt icky about the consolidation of their money, 100% gamble into OpenAI, but they also are a tier 2, I guess a tier 1 and a tier 2 SaaS company. But their debt situation was a no for me. And so it was between ServiceNow and SAP. And here's my thought process of why I went with SAP. Because the expectations for ServiceNow, even though they've been going on a ridiculous sell-off, 40% into the red in the past 1 year, past 6 months, 45% into the red, their trading multiple, their forward trading multiple is a 23. The expectations for this company is ridiculously high. Dividends, no dividends. Everything else, their financials and fundamentals are pretty good. So that's what made me go with SAP. Because I think in Nordic countries and Scandinavia as well, they're trying to deviate away from their reliance on American tech, right? So like Microsoft, ServiceNow, Google, and they're trying to rely on like European companies. So that was reason number 1. Reason number 2, with SAP, their valuation is a lot more palatable, right? Like even with their current trading multiple with 25 versus ServiceNow's 57, forward trading multiple is a 23, SAP's is a 21, and they just announced a dividend increase. Previously, it was $1.73. Now it's $1.90. Their dividend growth rate is 10%. Financials and fundamentals, super solid. So I went with SAP instead because Not only do I get a dividend in the meantime as the SaaS stocks continue to go up and down, but it's also a hedge against European companies acting emotionally and severing their partnerships with the Mag 7 in the US, right? So SAP, I think, will be the ultimate winner if European companies double down on supporting European companies. I think SAP is primarily a German company, but they do have offices all over Europe. They even have an office in Saudi Arabia, right? It's a global company. I really like SAP. I think the one thing that holds them back, from my understanding, like ServiceNow, Salesforce, Microsoft, they were early to adopting the entire cloud-based game plan, right? Getting your customer to jump ship from their own local network to having the tier 2 company in question host all of your data, all of your stuff, and then just pay them on a subscription method. For SAP, for the longest time, they allowed the companies to host their own data in their own IT department. And rather, you paid SAP like a license fee to use their software. But instead, SAP is now making that pivot into becoming a cloud business where they're no longer going to just sell the license. You need to migrate your data over to SAP. And because of that, SAP is also going to be going through a crap ton of Capex in the near future. But as you know on this channel, I have very unpopular opinions. Like number one, I love stock-based compensation. Number two, this one right here is going to trigger some people. I love Capex as long as it makes business sense. If you're doing Capex for Capex sakes, I don't agree with it. But if you're doing it in order to amplify and aggressively grow the free cash flow 10 years down the road, I'm all for it. And then number three, I'm a huge fan of dividend growth investing. Yes, I understand that mainstream investing says that dividends are stupid, dividends are useless, dividends are taxable events, dividends are this and that. I love dividend growth. I feel like I'm just a very controversial, stupid guy, right? As I go against all the mainstream opinions. Because for me, I think about it from the lens of an investor. Does it benefit the investors? Right? Stock-based compensation, it aligns the leadership team to that of the shareholders. Because they win if we win, if the stock price goes up, right? Because their compensation is tied up in RSUs. Number two, with Capex, what good is it to just have free cash flow for free cash flow's sakes? You might as well use it to reinvest back into the business to build out another manufacturing facility so that you can increase your throughput, to reduce your supply chain throttles. Hi, Novo Nordisk. That's why Eli Lilly ate your lunch during the GLP-1 boom, right? I think the more factories you have and you have economies of scale, I think it's a beautiful thing. But also with the cloud endeavors, I believe in it because that's the future. Right? Nobody wants to be messing around with their own IT department, making sure your data is secure, this or that. It's better to just hand it off to freaking Oracle or Google and just pay them a freaking subscription fee so that it has cybersecurity built in, so that everything is good to go. And they can deal with all the headaches and the data servers, the warehouses, and the management of it. Right? And then number three, dividend growth investing. Here's the thing, you invest to get an ROI. One way to get that ROI is to get some of the profits from the company's pockets into your pocket. It's not free money. It's a distribution of profits from them to you to reward you as the shareholder. That's why Warren Buffett, the dude that I really look up to, he put me on. I didn't care about dividend investing until I had to do a case study on that dude during my master's program. And then I started to see eye to eye with him. I was like, well, hold on. Dividends make a ton of sense. Dividends don't create value for the business itself, okay? They're distributing value that's already been created in the retained earnings, their profits. So when times get tough, obviously companies are going to prioritize survival, and that's why dividends can get cut. But that's very far and few between, right? You don't really get your dividends cut when you talk about a high-quality compounder. I mean, based on a study by McKinsey, even during the pandemic, when everything was a mess and a storm, 15% of the large cap companies that pay a dividend got rid of it. 15%. The other 85%, it was business as usual. They even raised or increased their dividends during catastrophic events. So the dividends don't get cut as often as people would like to believe. Because a dividend shows that you're excellent, that you're crushing it. But if you're not, you can't afford a dividend. So for me to invest into a dividend growing business, it builds trust. It's like, dude, they've been doing this for 40 years, 50 years. But there's companies out here where they cut the dividend, and that's not who I'm talking. I'm not willing to invest into those businesses. You know exactly who I'm talking about. The ones with shaky financials, the ones where their free cash flow goes up and down, the one where their stock price is inconsistent. Like, I'm not interested in those types of businesses. I'm interested in the ones where, regardless of the macro environment, regardless of the consumer preference, regardless of what's happening, their business just keeps growing. Their dividend just keeps growing. Like, that's who I'm interested in. But anyways, what else do we've got going on Wednesday? We also have Boston Scientific. So for simplicity's sakes, it's a medical device, medical tech company. However, if I pull them up right here, you will see that year to date, they're selling off, negative 32% into the red. And that's because some of their biggest growth drivers, it's been missing the mark lately, because I feel like the expectations for Boston Scientific have just been so astronomically high. So with this sell-off, I think the case can be made that their valuation has been reset to 18. Historically, that is really, really low. For their forward trading multiple based on next year's EPS, so 18 times next year's earnings per share, dude, that's really low. Low key, it's a company I'm contemplating jumping into prior to the earnings, but I have to do more research. I do not know if I want to. However, if you're a friend of this channel, then you know I'm super bullish about the medical device companies such as Medtronic, Edwards Life Sciences, Stryker, Johnson & Johnson, and Abbott Laboratories. The reason being is that as humans live longer and longer, it requires modern medicine and equipment to help us reach 80, 90, or even 100 years, right? Our body starts breaking down and we need some help. And medical devices, that's what helps, right? Measuring your glucose, helping your heart pump the necessary amount of blood, and the list goes on and on. So it's a company in an industry that I like. I just don't know if they're going to be free falling. So I will circle back on this one eventually, but Boston Scientific, remember the name. I'm not invested into them, but I do like them. There's Moody's. I really like Moody's. I really do. I was thinking about buying into them, but I think their valuation's still a little too fat. Yeah, their valuation's still a little too fat. Instead, I jumped into their peer, S&P Global. They're also a part of the Credit Reporting Bureau. I like S&P Global because it's a little bit more diversified than Moody's, but I don't think you can go wrong with either one. Let's see, there's Elevance. I don't plan on buying into another health insurance. I already put my marbles into UnitedHealth. I think what was the other one? I made like a 46% gain. Centene, yeah. So I invested into Centene during the sell-off last year. I sold out of them. I just feel like for the current administration, health insurance space is a little hostile, so it's probably not the wisest idea to buy into them right now. Maybe I'll revisit buying into them at the end of 2027 if they are still suppressed, because in 2028 or 2029, if there is a change in the party in power, they could pump really hard. So for right now, probably not the wisest idea, but oh my gosh, we also have Waste Connections. Another one of my core holdings out of the trash garbage disposal space. They are my number one. My number two is Republic Services. Number three is Waste Management. Once again, when I say that, I don't mean that waste management is trash. Waste Connections for me is S. Republic Services is S. Waste Management is A+. So they're all really, really good. Gosh, there's a lot of companies reporting on Wednesday. There's also another health insurance company, Molina. But again, I'm not going to invest into any more. Travel and Leisure, timeshares company. Wow, Wednesday's going to be pretty busy. Well, I suppose I'm going to be paying attention to what happens because the sell-offs happen. They'll drop down like, I don't know, a company in question could drop down like 10, 15% for that single trading day. And then the next day they rebound and then they're back up to the prices that they were in like a week, maybe like 2 weeks. That's usually why I tune into the earnings so I can take advantage of when investors are emotional and they punish them beyond belief. I do not jump in if the punishment is warranted. Like, say I'm invested into, for instance, Microsoft, and they decide to make a huge pivot into selling footwear, and they go on a sell-off of like 20%. I'm not going to buy that dip. In fact, I would sell too. Fun fact, the other day, Allbirds, the startup shoe company, I think they were like $450 a share right after their IPO a few years ago, and now they're like a penny stock, or they were. They announced last week that they were going to transition. They sold off their footwear line of the business, and now they're going to go into AI, computing, and their stock price went up by 550% on a single trading day. It was probably one of the craziest things I've ever seen. So not all business pivots are necessarily bad, but for me, if a company sells off because they make a pivot into a negative trajectory, I am not going to buy into it. But if it's business as usual, let's say the expectation was $1 billion and they posted $999 million and they missed it by 1 million and they sell off 15%, dude, I am buying in. You get my drift? Because that's overblown. That's dramatic. That's people being crazy. Like, if the business is still high quality and they missed it because of like a minor thing, like a production issue or a supply constraint or something happened that was out of their control and that's why they missed the mark, I'm buying in. That's why I tune into these earnings, and I'm not going to lie to you. That's how I make a good chunk of the green that I make. I mean, it takes a lot of work, but it's work that I don't consider work because for me, this is so, I know that's how you know I'm a vanilla, boring kind of guy. I find this stuff fascinating and entertaining and fun. To buy businesses and to make money from it, dude, sign me up, right? Like the whole idea of buying high quality compounders that pay me rent money in the form of dividends and compound my money, dude, I love it. My CAGR for the past, my total return for the past 3 years is like 90%. I almost 2x my money in 3 years, right? Like to do that from investing into dividend compounders, which he's like, I love it. I love it. Obviously, I did have some losers along the way. I'm like 45% into the red with the trade desk. I sold at a loss all of my food stocks last year, including General Mills, Flowers Foods. So I'm not trying to say that I'm the Oracle of Omaha, or I guess the Oracle of Japan. I'm really not. I lose as well. But the reality is my winners outshine the losers. Like, thank the good Lord, right? Because I think as I apply my hybrid strategy, right, value investing, never overpaying for a good business, dividend growth investing, GARP, growth at a reasonable price, the contrarian perspective, buying into the fear, buying into the sell-off. When I put it all together, it usually spits out a methodology that 9 out of 10 times, it usually puts me on the right path. Because even if I buy into a business that might be in a temporary stumble, like UnitedHealth, grand scheme of things, they're the biggest health insurance provider in the US. Their software is used in over 70% of the hospital systems in the US. They have their hands in almost every line of healthcare that I know deep down inside they're going to be okay in the long run, right? So like, that I'm not going to lose any sleep over. But I guess what I'm trying to say is the madness works. I said it again on this channel, probably for the 100th time. If it wasn't working and I was losing money, if I was underperforming consecutively, consistently, reliably, the S&P 500 was beating me like every single quarter, every single year, I would stop what I was doing. I would stop picking individual stocks and I would just do passive investing, dollar cost average into VU, which I do own. I don't know if I ever told you guys, I do own VU and VTI from my corporate days. And I would just do that. I would stop. But the fact that I beat the market ever since 2019, I'm not trying to say that I'm a know-it-all, or it's not me being arrogant or conceited. It's just, if you put in the time, the dedication, the effort, and the energy, like this is what I do 7 days a week while taking care of a baby. I think for me, it's worth it. Like if I was underperforming, I would stop. I genuinely would stop and just go full out SCHD, VU, VTI, and just talk about the stock market in general. But the individual picking of the stocks, it's been working out. Now, obviously, it's only been 7 years. Maybe in year 8, I'll underperform. Maybe in year 9, I'll lose it all. I will not lose it all because I don't gamble. I don't do options. I don't do margin. I don't do anything that's beyond my risk profile and tolerance. Like when I jump into a company, it's usually a blue chip, household, high quality compounder. Like what have I been buying in the past few weeks, right? Microsoft, SAP, some of the military stocks, right? I'm not buying startups. I'm not buying companies that are burning through cash. I'm not buying companies that are based on speculation or hype. I'm only buying into the tried and true battle-tested companies that are crushing and thriving. I think that's another reason as to why it's working, but I don't know. Like if you want the proof, like I posted on the communities tab here on YouTube, my total return for the past year. So to go check it out. Like I'm not lying. I have no reason to lie. I'm not selling an e-course. I'm not selling a mentorship program. Like I'm just sharing with you the lessons that I learned, and the lessons that I continue to learn, right? So yeah, it is what it is. Oh, there's American Express on Thursday. To be completely honest with you, they're overvalued. I did my analysis on them about a week and a half ago, and my personal buy price, I'll give you guys a freebie. For me, it's $250. So the fact that they're $331 right now, I'm not contemplating. So unless they sell off after their earnings, I'm not even going to pay attention. Because for me, the buy price, the entry position for me is going to be $250. And they're nowhere near that. I mean, they did get close to it. Let's see. Leading up to this earnings week, they did flirt with like what? $290 a share. And they were dropping down to $280, $270, but then they started rebounding. So, I mean, they'd almost got close to my $250 entry point, but not exactly. There's also Thermo Fisher Scientific. They're basically the redheaded cousin of Danaher from West Virginia. Also really good, also high quality, also a compounder. Another one that I want to pay attention to. Basically, everything that I said about Danaher applies to Thermo Fisher. It's a good one. There's Next Era Energy, probably my favorite out of the utilities space. I really like them. There's Union Pacific, a railroad conglomerate. There's also CSX reporting and Norfolk Southern, if you're into the railroads. And then there's Lockheed Martin. I remember for the past 2 years, if you're a friend of the channel, if you're not, then I'll just put you on. I made content about the military stocks because as an infantry officer, I had hands-on first world experience using the equipment that I trusted my life with, right? And I knew that the defense system, it prints cash. Because when you do business with the government and the government pre-approves your revenue for the next year and it consistently increases and grows, especially the defense budget, the US spends more on their military than the next 10 countries combined, the next top 10 countries combined. We are a country that will never reduce our spending on the military, because that also includes the salaries for our airmen, Marines, sailors, soldiers. I don't know what the Space Force people are called. Guardians, maybe. It includes their compensation. It includes their equipment, because we're not going to be making them drive tanks from the Vietnam War era, right? We're going to be continuously upgrading and giving them the newest and the greatest everything, unless you're in the Marine Corps. For the longest time, the joke was that the Marine Corps would get the Army's hand-me-downs. I don't know if that's still the case. Like, we used to give them our old Strykers, our old tanks, our old field artillery equipment. I don't know if that's the case anymore, but for the most part, all of the branches get everything brand new, everything. That way, we are the most, I guess, the strongest military force in the world. You can't really be that and do that unless all of your equipment is state of the art. So from my understanding of the landscape, I was like, okay, I'm going to buy big into it, because with the current party in power, one thing that I understand is these guys are bullish about the military. So I'm going to put my money where my mouth is. And so I invested a lot into it, right? And people were pushing back saying, dude, you don't know what you're talking about. The military stocks are terrible. They're trash because of their high Capex. And I kept telling you guys that Capex does not matter as long as the business thrives and grows. If the business grows and amplifies, it doesn't matter. Take a look at this. If you go to the free cash flow for Lockheed Martin, they're in the business of creating drones, missiles, and the F-35 fighter jet planes. Their Capex, I'm so sorry, right there. Look at their Capex situation. It is getting bigger and bigger by the year. $1.6 billion of Capex, because they're manufacturing the planes, right? So you would think because of that, their stock performance would be atrocious. But friends and family, it doesn't matter, because they're thriving, they're growing, they're just expanding. 51% into the green. I think a better example is my other one, Huntington Ingalls. They basically build the submarines, the carriers, the destroyers, basically any ships that the U.S. Navy and the Coast Guard uses. They also have a lot of Capex, because when you build out a carrier that puts like 7,000 sailors, it's basically a floating city in the ocean. It costs billions of dollars to build just one, okay? A lot of Capex, so you would think their stock performance would be hideous and trash. No, past 1 year, 83% into the green. That's just the past 1 year, right? So, Capex does not necessarily mean a company is going to be trash, okay? As long as they can produce the numbers to outweigh their Capex and to show that the Capex is beneficial, the stock price will follow suit. If the operations and the financials and the fundamentals are performing, then the stock price will perform alongside with them, regardless of the Capex narrative. That's why I say it all the time. Some of my best stock market performers have been high Capex spenders. And that's why when people say Capex is bad for business, I'm like, you really do not understand business at all, do you? You have to spend money to make money. If you want to beat out the competition, if you want to increase your economic moat, when you have 20 facilities, factories, manufacturing hubs, and your competition only has one, you are going to beat them out because of economies of scale. Because when they only produce 20 pairs of shoes and you can produce 20,000 pairs of shoes, you're going to beat them out because your shoes are going to be on every single shelf of Foot Locker, Dick's Sporting Goods, on Amazon. You're just going to overwhelm them, right? And the cost to do business will be cheaper, but also it increases your economic moat in that when you have all these facilities and capabilities and factories producing a specialized good or a service, for someone to come up and try to fight you, a startup, dude, it's going to be so challenging. That Capex is what separates you from the pack because you will have the production capability, whereas they do not. You cannot overnight create a U.S. Navy carrier building company. You can't do it out of the blue. You cannot. Huntington Ingalls, they're able to do it because their Newport News shipyard and their other shipbuilding facilities, they've been doing it for decades. They have all of the equipment, all of the tools. They have everything in place to produce, and that's why there's no point trying to entrench upon their territory. And the examples can be made again and again in other areas, but obviously I do think Capex for Capex sake is stupid. Like if you're struggling and you're saying that you want to build out another factory, I don't bless off on that. Try to do with what you've got and improve your margins in the meantime. Like find out why you're not thriving. Like the solution's not to build another factory, but in the case of Google, Microsoft, Amazon, Meta, the reason why they're building out these data centers, I tuned into the earnings, and it's because their bandwidth is 100% tapped out, meaning they want to take on more revenue, more contracts, more customers, but they physically cannot. So they have to build out the infrastructure so that they can host more data, host more customers, host more everything else. And that will equate to more money, more revenue. You get my drift? So I love Capex, and whenever people say it's bad, I just giggle, okay? Because as a guy that used to work in operations, I understand that Capex is a bullish thing, especially if it makes sense. I will say it one more time for the keyboard warriors, Capex for Capex sake, I do not bless off on. If you're doing it because your business is thriving and you're doing it to even further your economic mode or to even make your production throughput more efficient, I love it. But if you're doing it because you're struggling, then you're stupid. Try to work with what you've got, try to optimize your facilities, and then when you have the formula down pat, then open up another facility. That way, it won't be a dumpster fire right off the gate. Because if you're struggling with what you have right now, what makes you think that when you open up another one, that's not going to struggle? Because then the margins for that, it's going to crush you, right? Because you're spending a crap ton of money on all the overhead costs, the salaries, the bills, and everything else that goes into the new facility. And you're not even going to be able to do it in a more efficient, optimized manner of whatever it is that you're producing. Okay, whatever. There's also a big HVAC conglomerate fix. At this point, I'm not even considering them. Probably one of the best companies that I can think of in the past 5 years, and it's not NVIDIA, it's not Broadcom, and it's not AMD. 1,900% into the green. Comfort Systems USA. Look, I love the HVAC space, and I definitely think they're in the S tier, but this ship has sailed. If you're thinking about buying into them, with a trading multiple of a 45, dude, I don't understand you, right? I would need a huge pullback for me to contemplate jumping in. But out of the HVAC space, one that I am considering right now, they're hovering around a fair value, is Carrier Global. But even them, they've got more room to fall before I would consider. There's also NASDAQ. I really like this one. There's Edwards Life Sciences. So I feel like all of the medical device companies have been reporting as of recent. So this is a good one, but personally, all else being equal, I think I would rather go into Boston Scientific rather than Edwards. But again, I need to do my homework on Boston before I can say that definitively. There's Roper Technologies. I really like them in the SaaS landscape because they specifically cater to the government, municipalities, courtrooms, police systems. And when you think about that type of customer base, change comes really slowly. They're not going to just vibe code what you use for court documents or to handle the tax information for your city council. They're going to continue using the software that Roper makes for them. When you think about tech startups, yeah, they might jump ship. When you think about some of the S&P 500 companies, yes, they might jump ship. But when you think about the government systems in the middle of nowhere, Alabama, they're not going to go to a vibe-coded software, okay? This Keurig Dr. Pepper, a regional bank, Huntington, dude, there's so many heavy hitters. Wow, there's a lot of companies. There's Hasbro, which I changed my opinion on. This is a company that's in the business of making toys, board games, and they also own the intellectual property for Dungeons and Dragons, but also Magic the Gathering. I did no, it wasn't Hasbro. During my MBA accounting classes, we had to dissect Mattel, And another one we did was Wolverine Worldwide, ticker symbol WWW. But I feel like I personally looked into Hasbro, and it's a company that I do like, just not at their current price. For the past 1 year, that performance is just phenomenal, isn't it? 87% into the green. And that's because they've been digitalizing the Dungeons and Dragons and Magic the Gathering dynasties. Instead of just being a board game or a card game that you play in person, they're also trying to turn it into an online thing. And then that means digital currency, and it's opening up an entire new pathway of revenue for them. I really like Hasbro, just not at their current price. But let me see, where anybody else besides Hasbro after that? There's Pool Corporation, which I just broke down Trex, which is in the consumer discretionary spending, because you don't really necessarily have to replace your decking, your traditional wood decking with composite decking. It's nice to have, but it's not a must, right? Just like a pool, you don't really have to have a pool or necessarily change out whatever it is to keep it running, but it's nice to have, right? And I said all else being equal, I'll stand on my hill. I'd rather go with Trex than Pool Corporation. I'm not really a fan of Pool. And then there's Kinsale Capital Group, an S-tier insurance player. They're going through a little bit of a headwind right now. There's Rexford Industrial. They own it's a REIT that owns a bunch of properties, factories, and warehouses in Southern California, which, by the way, I think it's like the fourth or the fifth biggest industrial region of the world, Southern California. Even if California were to separate from the rest of the US, they would be top 20 GDP country. Like, California just produces so much revenue. I own this company, by the way. It's in my dividend income portfolio. Reason being is that I'm kind of bullish on it. I mean, obviously, I thought about the tax landscape of California and also companies jumping ship to Texas and Nevada for the tax treatment. But the Port of Los Angeles is one of the busiest supply chain ecosystems that keeps the West with the East. Anything that comes from China has to go through the Port of Los Angeles for the ones that are coming on a cargo ship. Like, the industrial area of SoCal, I'm bullish on. The rest of the state of California, with the cost of living and the businesses jumping ship, it does worry me, but the industrial area, the Port of Los Angeles, I'm bullish on. Okay? Anybody else? I mean, we're still in the mid-cap, small-cap territory. Because as a rule of thumb, I don't really like looking at companies that are micro caps. Like, if your market capitalization is like 100 million, not really interested in you. Okay, Friday, we've got Proctor Gamble. It's a core holding of mine. I would say it's a buy and hold, right? I really like them. I contemplated selling out of them when I sold out of Clorox, when the value stocks all went on a rally not too long ago. I do this right here. So back in February, all the value stocks were pumping, right? And I jumped ship with a lot of my value stocks, and I rotated that into Microsoft and some of the SaaS stocks. Because at that point, when I saw the value stocks having PE ratios of like 30, 35, I was like, dude, that doesn't make sense. And then when I saw the SaaS stocks getting punished beyond belief, I just rotated my money. For me, it was simple mathematics. But I didn't sell, because for me, Procter & Gamble, when I say buy and hold, I mean, when you think about the next 20 to 30 to 50 to 100 years, Procter & Gamble's in the business of selling products that we'll just continue to use, right? They do diapers. They sell feminine products. They sell... Okay, here's the thing. The key metric to watch with Procter & Gamble is their volume. Wall Street does not want to see them growing their numbers by increasing the prices only, because that's what's been happening, right? They're selling less inventory, but they're still making more money because of the price hikes. And Wall Street, they're not a fan of that. They want to see more of their products falling off the shelves. Or selling off the shelves, or is it falling off? I don't know, flying off the shelves. They want to see more laundry detergent, Tide, Gain, toothpaste, talking about Crest, shampoo. Not a sexy business model, not an AI operation, but it's a company where, against the competition, Church & Dwight and Colgate-Palmolive, I always say that Procter & Gamble is tier 1. Tier 2 would be Colgate-Palmolive, and then Church & Dwight would be tier 3, like that budget category where the detergent doesn't clean your clothes as well. I used to think that it didn't matter. I'll tell you this right now. Once I started doing laundry every single day because of the newborn, the baby, I transitioned from using the generic crappy laundry detergent to using Tide. I kid you not, there's no more stains on our clothes. I used to think it did not matter. No, I was so wrong. I used to use the cheap crap. It does not clean as well. I don't know what it is about Tide, but it cleans so freaking well. I just refuse. I will always pay premium to get Tide. And I know there's people like me out there. I thought I was saving money by buying the generic brand. No, it doesn't clean as well. Especially with a baby, I do not want puke on my shirt. I do not want to walk around with puke on my shirt. I don't. I'd rather have it gone. And then when we talk about even dish detergent, Procter & Gamble is the parent company of Dawn dish soap. So even scientists, when there's oil spills and there's cute little ducklings that have oil all over them, what do they use to bathe them to get rid of the oil? Dawn dish soap. Again, I used to use generic dish detergent and never ever cleaned the grease as well as Dawn. So that's another area where I refuse to cut costs on. Even if Dawn dish soap is like $2.99 and the generic brand from Colgate-Palmolive is like $1.99, I will go with Dawn dish soap because you use less of the product to get better cleaning. So in the end, you save money. So that's my thought process, right? I'm not one of those idiots that fills up the laundry detergent to the line 5 on the cup. For most loads, I go up to 2. If it's a heavily soiled vomit, poop, piss all over the freaking shirt, pants, then I'll go up to line 3. Just to show you, like, I'm not an idiot out here that's just like wasting money. It just made more financial sense using the better quality product that does a better job cleaning because I use less of it. With the crappier substitutes made by Church & Dwight, for instance, because I'm not lying, I was a penny pincher and I used to buy the generic stuff prior to having a kid. Dude, you would have to use more of the stuff to get even 50% of the cleaning power. So, I don't know. I like Procter & Gamble. Regardless if they sell off, I'm just going to hold on. Even if they rally, I'm just going to hold on. I like Procter & Gamble. What do we... there's Norfolk Southern. This is a company that I held for the longest time. I think I sold out of them for like a 45% gain about a year ago. I haven't looked back. And I think I pivoted that money into NVIDIA at the time. And I think I would do it again. I think I made the right decision. I sold out of Visa and Norfolk Southern at the end of 2024, and I put it all into AMD and NVIDIA, and that worked out a lot better. So I have positive feelings about Norfolk Southern for what they did to me. But as a business operation, listen, I like the railroad stocks, especially their recent performance. It's been pretty yikers. What's a better way to show this? Is it okay? In terms of recent performance, Norfolk Southern is 41% into the green. Good recent performance, but for the majority of the time that I held on to them, they were pretty much flat. Like I bought the dip into them right here at the end of 2023, and I think I sold out of them like right here-ish, November 2024. I pivoted it into NVIDIA and AMD. It's a cyclical stock, right? The railroads, I love them, right? They transport a lot of the heavy stuff like stones, chopped wood. And in the future, I think the railroad stocks are going to benefit from the high-speed trains if that ever becomes a thing, like here in Asia, like in Korea, China, and Japan. Dude, high-speed rail, it would change the name of the game, but it would also hurt the economy of the U.S. because so much of it is contingent upon drivers, right? Truck stops, you got exits that are full of hotels, restaurants, all of that would get hurt if more people use trains to travel instead of driving. So it's like a give and take kind of a thing. I feel like there's going to be a lot of pushback from the hotel companies, restaurant companies. Me personally, I love high-speed rail because you get to your destination at a fraction of the time. You don't have to deal with bumper-to-bumper traffic, fraction of the cost, and you don't have to drive. You could sit there and listen to an idiot like me ramble on a podcast. You can play on your mobile phone, play a game on there. You can do whatever you want. You can take a nap. I guess that's why some people say get a Tesla, right? Just drive yourself to a destination. But anyways, Norfolk Southern, I like them. Just not a company that I would invest into again. I think they're good. I just don't like the cyclical behavior of their stock price. Up and down, up and down, up and down. It's not smooth and steady. There's Fiserv. I'm bearish on them. But we also have, there's one more that I wanted to talk about. Western Union. Gosh, this is a company that so much potential in the world. Past 5 years, 63% into the red. They've just been messing up so much. They remind me of AMC. I knew that the CEO of AMC was dumb when I tuned in 2020 during the pandemic, when we weren't allowed to go outside. The analyst asked the CEO, who's a freaking Harvard grad, just goes to show the name of your school does not mean that you're intelligent. He doubled down saying, no, AMC will stay as a physical movie company. And I was like, you're an idiot. If customers are not allowed to go out and spend money at the movie theaters and you're doubling down on that, you're an idiot. That would have been the perfect time for them to pivot and also do online streaming because AMC also owns a lot of intellectual property and they also have shows and movies. They could have had a streaming platform and benefited from the streaming wars in 2021 and 2022 when Disney and Paramount and all the other companies pumped. They could have done that, but they didn't. They doubled down on a dying business model. And I kept thinking like, dude, you're an idiot. Same exact sentiment with Western Union. I think it's the poster child of when you have a dying business model, because they help people transport cash from one place to another. And if we're going to be honest, I don't want to be politically incorrect here. The biggest customer base for them were illegal immigrants, recent residents that moved to the U.S., transporting cash from the U.S. to wherever they came from, Guatemala, Egypt, and other parts of the world, right? Because their customer base, they couldn't get a traditional bank, they couldn't do this or that, so they had to move money to help their families back home, which I think is a noble cause. And when you're in the business of moving money, physical money, you should have line of sight to realize that that's only going to be temporary because everything's turning digital, right? Now they made the pivot into helping out with an online digital app and doing all that, but I think it's too late. They're way behind the game. They should have made that pivot at the end of 2021. But the fact that they decided to do it in 2025, this is a company where their financials and fundamentals have only been decreasing since 2018. $5.5 billion in 2018, and it's only been falling every year since, except for 2021. Western Union, I think it's a poster child of, that's why when people articulate to me that dividends are stupid, I would rather want to see share buybacks. I'm like, dude, it doesn't matter. If the business is failing and you do share buybacks, it can't save the business. Western Union has been buying back their shares aggressively every single year since 2007. And has that been saving their stock price whatsoever? No. I think share buybacks only make sense when the business is crushing it to the point where there's no more use for your excess cash. Even if you put it into R&D or marketing, you're not going to yield an ROI. So you might as well buy back the shares. For Western Union, they're losing money and they're buying back the shares. And that's why I say they're an idiot. You might as well use that money and to aggressively try to do an M&A, acquire a startup, fintech company, try to merge with someone else, or spend millions of dollars in marketing or try to develop something to stay relevant. No, they doubled down on the share buyback game plan. And has that helped out? That's why, for me, I would rather see dividends than share buybacks. Just because you do share buybacks, it does not necessarily mean the share price is going to go up. Another poster child is Adobe. Another poster child is PayPal. Share buybacks does not guarantee an ROI for the investors. Dividends will give you an ROI. You will get that tangible cash payment into your brokerage account, but it doesn't necessarily mean the share price is going to go up, right? But all else being equal, I would rather get the dividends. Now, I think Western Union, if you're invested into them or if you're contemplating it, not financial advice. Me personally, I would hesitate. This is a dying company. It's a melting ice cube. I think it's only a matter of time before they're obsolete. They dissolve or they're going to get swallowed up by a private equity firm for they'll probably do a buyout of $3 per share to the shareholders. I just don't see a bright future for them. I'm so sorry, but Google Pay, Apple Pay, Samsung Pay, the big tech Mag 7 companies, they came here and they ate their lunch. Their business model doesn't make sense anymore. So if I think about the melting ice cubes in that exact same space, PayPal versus Western Union, I mean, this might be controversial. I'd rather go with PayPal. I feel like with their Braintree, what is it called? Their parent umbrella that creates all of the new endeavors. Whatever, PayPal's brains are better than Western Union's. Western Union's, I just feel like, I don't know. If they were to pivot into some kind of crypto exchange or a Bitcoin vault, or if they were to do anything innovative, risky, their stock price would have pumped and their numbers would have followed suit. But the fact that they doubled down on the physical transference of cash, and then in the past 8 months saying, oh, now we opened up a digital mobile app. It's like, dude, you're too late to the game. You're too late. There's literally 20 other alternatives that people use from Honduras, from Ecuador, from Argentina, rather than Western Union. It's a dying company. It really is. So it's kind of sad to see. If you're invested into them, I'm really sorry. But I honestly think if they do decide to go in that route that I just described, if they become anything involved with cryptocurrency, or they follow the same footprint as SoFi, or do anything ballsy, edgy, and push the boundaries a little bit, I think they can make a recovery. But if their leadership, I tuned into 2 of their earnings, I don't think they're going to take any risks. I think they're so content with the ship sinking. Why is that, Amos? Because the whole idea of the stock-based compensation, remember what I talked about? Western Union, they don't do stock-based compensation. The last time they did was 2009. They have no skin in the game. So you think a senior manager, a director, a VP, do you think the executive C-suite, they give a crap of what happens to the stock price? They don't care, because their compensation is not tied up in RSUs. Again, that's why I love stock-based compensation. They do not care if the stock price crashes. Are you starting to see what I see? But Amos, they do share buybacks. Okay, but how is that helping them? The company is still sinking. Why are they not trying to become more innovative, right? Their SG&A, it looks like they've been doing layoffs aggressively since 2020. Gosh, this is, I don't know. Maybe I should stop, right? I don't want to step on too many toes here, because I know Western Union is a favorite among the dividend community because of their high dividend yield of 9.9%. But for me, it's destructive share price appreciation I don't really like it. With a high yield, I would rather want to see the share price be stagnant, kind of like a QQQI from Neos, right? The share price being stable while fostering a 14% yield. Best case scenario, I want to see something this is a terrible example because the BDCs are getting their nuts kicked in right now, like Main Street Capital. But best case scenario, I want to see a high yield plus the share price appreciating week after week. But to see a high yield be accompanied by share price destruction, it just doesn't add up for me. It really doesn't. And if you take a look at their key metrics, revenue decreased by 3.8% year over year. Their net income, which is their bottom line, decreased 47% year over year. Bottom line per share decreased 44.5%. It's a sinking ship. I'm really sorry, guys. So, quick side note before we end. I just wanted to give you my gratitude and appreciation, right? You guys have been showing up for this podcast series. Every single week without fail, it gets like 1,000, sometimes like 1,500 views. I didn't think the long form content where I just hit record and talk would resonate, especially consistently with y'all, but dude, it's been such a blessing to see. Because as you know, I'm taking care of the baby full time. I'm a stay-at-home dad, but I do YouTube on the side for cash. And it's been helping, right? Each one of these podcasts, I get about $8 to $10, and you're like, that's nothing. But it compounds, right? Because the views keep trickling in, then eventually I'll make like $1 or $2. That's just one video. And then when you multiply that by like 4 videos, 5 videos, 10 videos, it adds up, right? I'm not making a lot of money. I think right now we're at just $200 even for the month. Obviously, because the upload cadence has been dropping, but it's good to see that you guys are staying consistent with me, because I like to do it as well. Like, this is what I love. This is what I do every Sunday. I used to annoy the living crap out of my wife when I used to talk to her about stocks, the companies that are reporting. She would point blank tell me, like, Amos, I know you're passionate about that stuff, but I just really don't care. And then I was like, you know what? Maybe I'll start uploading onto the internet. And then one thing led to another, and now we're 21,000 subscribers deep. So, with taking care of a baby, brother, I will tell you, I have to force myself to even work out these days, right? Before she was born, dude, I used to run like 5 to 10 miles a day. I hit the gym 5 to 6 days a week. Calisthenics on my days off. I work out a lot. No, I'm not a musclehead. No, I don't have a lot of mass. I intentionally keep my frame kind of lean. That's because when I used to do bodybuilding, dude, it costs so much money to get the adequate amount of macros and protein in. So now I just work out to stay healthy, but also for my mental health. Yeah. So point being, I literally have zero energy after holding down the fort with all the chores that I have to do, especially I love my baby, don't get me wrong. We have good days and bad days. But when you're up at 6 a.m., she's screaming in your face, you calm her down, she vomits on you, she poops on you. You do it all over again in an hour and a half. You repeat that until mommy comes home at 5:30 p.m. and she helps out. It's a lot, right? It's a change of pace, because I used to be a corporate guy, managing a team of 5, a team of 20, team of whatever. It's a different kind of stress, right? And so my respect for stay-at-home moms went through the roof. After doing it full time, I'm like, holy moly, this is hard. So all that to say, this kind of content, a podcast, it's just so good to kick it back and talk stocks like this, right? Because like the other content that I make, I love to do it as well, but the theatrics and it's so time consuming, right? 30 to 40 hours to get a video uploaded because of the script, the thumbnail, the filming, the editing. But these podcasts, dude, I'm not joking. I just hit record and I talk, right? And I also wanted to say my apologies if I talk about men's mental health a lot. It's just in the past, especially my early phase of my military career, went through severe depression where sometimes I would go to bed and I'd be like, dude, I don't want to wake up. I just don't want to live anymore. I hate my life. I feel like a piece of scum. I feel inadequate. I feel like the world would be better without me. Very toxic mindset and way of thinking, right? Eventually, I was able to get better, right? One thing I learned about depression is it comes and goes, right? That's why I started out the video by saying, seasons come and go. There's a spring that transitions into summer, to fall, into winter. Nothing's ever permanent. That's what I learned. And that's why, as I'm relatively stable, I'm like, man, I remember those days. And I think playing as my own therapist here, I think I'm one of those guys, individuals, where a lot of my worth is tied up with purpose. sense of what is my contribution to my circle, to my community, to humanity. And I feel like whenever the value system is not aligned with what I am doing in my day-to-day, if it's not serving a purpose that's impactful, I think it's hard for me to buy in and do what I do, right? But for however long this channel's been up, I want to say end of 2020, I don't know, is it 2024? I don't know. For the past like 2.5 years, I got that sense of purpose back. Like, dude, I'm making content about something that I'm passionate about. And by doing so, it's also helping people to learn from my mistakes, but also I'm a different platform because there's a lot of different YouTubers and social media guys that are pumping stocks or advocating day trading and doing all sorts of like weird stuff, like get rich quick schemes. Whereas I know that doesn't work. You might be lucky once, you might be lucky twice, and you might lose it all in the third try. What I'm doing here is like the slow and steady, the consistency, the dividend growth investing logic, the long-term horizon thinking. And like deep down inside, I know that at least one guy out there has to be benefiting from the content. And taking away from YouTube itself, like as a dad raising his child, like I know my life right now has a lot of meaning and purpose. And so my day-to-day is like, dang, dude, there's someone who depends on me to make the right decisions, to be able to control my emotions and urges, to be calm when other people would otherwise be angry. But also with like YouTube, like, man, your content is helping to shape people to make better decisions rather than YOLOing, rather than panic selling, rather than doing stupid stuff. So I feel good. But it's also like the small day-to-day decisions, right? Working out consistently, eating healthy. I stay away from all content that is sad. I don't watch heartbreaking movies. I don't listen to sad music. I stay away from all that stuff because I learned it has a huge influence on your mood and your emotions. What else is something that I've been doing that just helps? And to think positively. I thought it was such a stupid cliche when I was a younger guy. And then as I grew older, I realized what's the alternative? To complain, to be cynical, to be a dick, to be a jerk off, right? If you're not going to choose to see the glass half full and be optimistic, you're just going to be a complainer. That's who I am. And so I have to force myself to just be a happy guy, to be a chill guy. There's a lot of day-to-day life choices that I make, but also with what I'm doing in this season of my life that all aligns in me just being stable. And that's why, like, I apologize for talking about mental health a lot. It's just, I went through a lot, right? I'm not even joking. I shouldn't even be alive. I don't want to get into that story. But the fact that I'm able to look back right now. I'm like, dang, now I'm a dad. Now I'm married. Now I'm doing meaningful work. Now I'm able to wake up every day and do what I feel as if adds a positive contribution to society in a way that I'm doing it. It's like, oh, I love it. Anyways, I guess if you take away anything from that, I think it's good for guys to communicate rather than bottle it up. Because being in the military, having a lot of friends that are still in the military, I've lost a lot from taking their own lives. And I just feel like as men, we bottle it up. And then we just, you know what I'm saying? We resort to the last option. And I used to have a lot of guilt about that. Like, man, I wish I would have reached out to him, or maybe I should have picked up the phone call. And I think if we want to make that change, it's got to start with yourself, right? I think the more that we open up, the more that we talk it out, the more that we communicate. Because sometimes, dude, I'm not even trying to be cheesy here. Sometimes you just need a good cry, and then you'll reconsider doing something that's permanent, right? Sometimes you just need to talk it out, cry it out, and then like it's like soul healing. Seriously. That's one thing that I wish more men would do. Just talk one another, like realistically, your problems, and just be there for each other. I just hate the whole idea that narrative of men have to just suck it up, soldier on, take the beatings, right? I don't know. Anyways, I'll catch y'all in the next episode. I love you. Stay safe. Good luck in the stock market. I appreciate you guys for hanging out with me. See ya!